Welcome back to OptionFlow. I'm Lou, OptionFlow founder. In OptionFlow, we are dedicated to empowering traders with knowledge and strategies to navigate the world of options trading. So, in today's video, we'll provide a comprehensive overview of basic option strategies, their risk-reward profiles, and we are going to discuss how to select the most suitable strategy based on market condition. So let's get started. First of all, disclaimer, as usual, I'm not here suggesting you what to do with your money, how to invest your money. It's your business, your responsibility, your choice. This is my personal blog, so I share my own ideas, my way of thinking. I share what I do with my money and what I teach to my investors because I am a high-ticket mentor. I'm a businessman, I'm a mentor, I'm an investor. I teach a few selected investors a step-by-step strategy, a step-by-step method to invest personal money to generate or improving a stream of income month after month, year after year, with low risk and with few hours a month. Okay, so you don't need to stay in front of the charts many hours a day, just a few hours a month. Okay, because like everyone, my ideal investor has his or her own business, or they're self-employed, or they have a job, family, so not so many hours to be in front of the charts, okay, every day. So just few hours a month, but generating a stream of income. That's what I teach. Okay, so if you are investing more than $20,000 and you want to generate a stream of income in any market condition to know exactly what to do, click on the link below this video. There is a Calendly link to book a free consultation call with me. Okay, so first of all, in this video, let's review some fundamental option strategies. So a call option. Call option gives the buyer the right, but not the obligation, to buy the underlying asset at a predetermined price or strike price within a specified period, an expiration date. Okay, so for example, this is the chart, the SPY chart, the ETF. Let's make an example. So we buy a call, today's price is $506, kinda, and we are going to decide to buy a call 530, for example, okay, with expiration date a couple of months, 60 days. Okay, just make an example. So I, as a buyer, as a call option buyer, I pay a price. Okay, I have the right, but not the obligation, to buy, in this case, 100 ETFs SPYs at this price, $530, within an expiration date. So within, in this example, 60 days. But why should I buy an option, a call option? Okay, because in this example, I believe that the price is going higher than the actual price. Okay, in my mind, I think that within 60 days, ETF SPY will go higher than $530. Okay, so that's why a call option buyer think. Okay, let's see the other direction, put option. So a put gives the buyers the right, but not obligation, okay, to sell the underlying asset at a specific strike price within a specified period, so within an expiration date. So the call buyer has the right but not obligation to buy, in this case, buy 100 ETF SPY at $530. Let's make an example with put. I buy put 60 days, okay, like the example before. I put $470, okay, just for the example. So as a put buyer, I have the right, but not the obligation, to sell 100 SPY ETFs at $470 within 60 days. So why would I buy a put? Because in my mind, as a put buyer, I think that ETF SPY would go lower than the actual price within 60 days. Okay, there are other reasons to buy a call and put, but let's just make it very simple to understand. Okay, so I would buy a put because I would expect a price lower than $470. Okay, so call have the right to buy the ETF. The put buyer has the right to sell. What is an option spread? An option spread involves simultaneously buying and selling options. Okay, there are only two options, calls and put, but the combinations of these two options are really a lot. Okay, so option spreads involve buying and selling options of the same type, either calls or puts, but with different strike prices or expiration dates. Okay, so the spreads are advanced strategies, but let's make simple in this video, and let's examine the risk and reward profiles of these strategies. Buying a call option offers potentially unlimited upside reward with limited risk, because the risk as a call buyer, okay, we have bought in the example before the $430 call. Okay, so what's the risk? The risk is only the premium paid. So if I lose, I will lose on the premium paid period. Okay, what's the potentially reward? Potentially it's unlimited, because SPY could go higher than $530. Okay, 1,000, 2,000. Okay, it's not probable, of course, but potentially you have, as a call buyer, no limits of the profit, of course within the expiration date. Okay, as a put options, what is the risk reward? Buying a put option provides downside protection and profit potential if the underlying, in the example we have bought the put $470, okay, if the SPY price declines below the strike price. Okay, so the risk is the premium paid as the call period, no more than the premium paid. In this case, we don't have unlimited potential because the maximum of the SPY ETF price is 0. Okay, so it's limited. Okay, of course, it's not probable to go to 0 within 60 days. Okay, but potentially we have a limited profit. Okay, so how to select the most appropriate option strategy based on market conditions? Well, in this video, I talked about buy a call and buy a put. So I told you just there are spreads, there are lots of combination. We could make buying and selling with different expiration date, different strikes, but these are material for other videos. In this case, buying call option, when it's better buy a call option in a bullish market. So in a bullish market, consider strategies like buying call options or bull call spreads to capitalize on upward price movement. Okay, so buy a call in a bullish market. In a bearish market, consider strategies like buying put options or bear put spreads. Okay, so just to tell you, but there are other strategies to profit from downward price movements. And in neutral market, there are other strategies. Okay, neutral market, for example, it's a movement like this, a few dollars more, few dollars less, but behind the more or less zero movement. You need to consider strategies like iron condors or butterfly spreads to generate income while minimizing directional risk. This is the most powerful things about option. You can be profitable in bullish markets, in bearish markets, in neutral markets, even if the underlying doesn't move at all. Okay, you can profit for. There are strategies. Okay, so in this video we have seen just two simple strategies: buy calls, buy puts. Okay, so as you continue your options trading journey with OptionFlow, understanding various option strategies, their risk and reward profiles, and how to select the most suitable strategy based on market condition, this will be key to your success. Okay, so remember to always conduct analysis and risk management before executing any trades and investments. So do your own study, your own research. So if you're ready to learn and implement option strategies with OptionFlow, schedule a free consultation with us today. There is a calendar link below this video. So thanks for tuning in. Don't forget to like, subscribe and share this video with fellow traders and stay tuned for our next video. Okay, happy trading, happy investing, and see you in the next video. Bye.